The BEA just released the inflation numbers this morning. The PCE is flat at 2.6%, but the core PCE, which excludes the food and energy, is up 2.9%. So this is still above the Fed's comfort zone. We can see that the income have risen, the consumer spending also has increased, and the savings are actually going down a little bit because the spending are a little bit higher than the income. So what should the Fed do and how their decision is going to impact your portfolio? I'm going to talk about two risks that almost everyone is missing at the moment when the Fed is going to meet in September, and the two moves to protect your downside without killing your upside. So these changes are happening fast, as you can see, and there's so much political noise. It's hard to kind of like discern the noise from the fact, and this is why you need to stay informed. Make sure you click the like button, subscribe to my channel, and let's get started. So what's going on? The personal income has increased 0.4% on the monthly rate in July according to the estimate. So this is good news. So the personal income, that means the income less the current taxes, also increased by 0.4%. The things that the personal consumption expenditure increased at 0.5% month over month. So when we're looking at the income that was added here, you can see that the income went up a little bit, but you can also see that the outlays also went up a little bit higher than the income. So that's why the savings rate actually went down in July. When we look at the percent change in PCE price index from the same month but a year ago, you can see that the full PCE has risen by 2.6%, and the core PCE, that means excluding food and energy, has gone up by 2.9%. You can see here that the food, services, and energy actually have negative impact on the price index, so this is a good news, but this is also something that's impacting the core PCE. And the core PCE is what the Fed is looking at when they're trying to determine if they should take action or not. And the Fed is trying to maintain a 2% core PCE, so we'll see how they're going to react to this news. Many investors believe also that the stock market might be in a bubble territory. Other facts that we need to consider is that Q2 GDP was revised up from 3% to 3.3%, and they associated that with more investments. So if you look at this article here, the US economy expands at a revised 3.3% rate on stronger investment. Inflation adjusted gross domestic GDP, which measures the value of goods and services produced in the US, increased at a 3.3% annualized rate in the Q2. So that's compared to the initially reported 3% increase. Business investment expanded at 5.7% pace after surging in the first quarter. So the latest figure was stronger than the 1.9% that was initially reported. So that's a big difference. Here's a Citigroup economist, Veronica Clark, is saying that the revisions do not change the story, that underlying demand is slowing outside of a few very specific parts of the economy. We expect underlying growth will slow further as the labor market weakens and tariff costs increasingly weigh on activity. They're saying that even though we've updated the GDP from 3 to 3.3%, really the economy is slowing down. Labor market is softening, but it's also close to full employment at 4.2%. The tariff, also another kind of item here, is that the tariffs have not fully impacted the economy yet, but we think it's coming because the import prices were up 0.4% in July compared to June, and these are going to have to come in through the whole manufacturing process before it hits the consumer. So we're not going to see this maybe for another quarter or two. But these are the facts. So if you were the Fed right now, and let's ignore the political noise. Let's say there's no political noise. There's no president that's breathing down your neck and is pushing you every day to cut the rate. Would the Fed actually cut the rate at this time? And I think that to avoid further increase in inflation and prevent an asset bubble on the stock market, the Fed would either stay the same and not take any action and see what the tariffs are doing, which is basically what the Powell wanted to do, or they might decide to tighten the economy to avoid further inflation and avoid potentially a market bubble. So they want to kind of like tighten things up. That means raising interest rate. That means quantitative tightening. That means the Fed selling more treasuries and selling mortgage-backed securities that they have on their balance sheet, basically to pull the money out of the economy so that it's going to kind of like tighten the amount of cash that's being invested, etc. And that would prevent the bubble. That would also reduce the inflation because less and less people would be buying stuff. But so far the Fed decided to wait and not take any action and see how the tariffs is going to play out, etc. But this is kind of my take. If there was no political noise right now, I think the Fed would actually tighten the economy. So the two risks that I see here, so if we add back the political noise, so it's not surprising that Trump is putting a lot of pressure on the Fed to cut the rate. They've been threatening to fire Powell. Now he's trying to fire Cook and weaponizing the Department of Justice against Cook to force her to quit and to resign. But all these political games so that they can gain control and reduce the rate for whatever reason they want to do it. If the Fed decide to cut rates in September, I think it's going to cause two things here. So two risks. One of them is that the Fed would be seen as no longer independent. So whether they do this, they cut the rates for the right reason or not, this is the impression is going to give to the world, is that basically they're following the government, they're following the president, and they're no longer independent. Historically, the reason why we have an independent federal central bank is that the government would always want to have the lowest interest rate. They don't care, they just want a low interest rate. They would never consider increasing the interest rate, and they would weaponize the central bank to lower the interest rate when it's time for the election, maybe increase it at some other times when it's more appropriate for them. But this is not the right way to do it, obviously, and this would cause inflation, this would cause additional risk. And for this reason, if the Fed is no longer seen as independent, that means that the long-term yield would also go up because their risks are going to be higher and the future inflation potential is also going to be higher. The second risk is that the Fed would be more concerned, it would appear that the Fed would be more concerned about the labor than the inflation and a potential stock market bubble, and feel that they need to stimulate the economy. So there's something that we're not seeing, that the Fed is seeing, and then there's an additional risk, and the investors don't know what it is. So the impact of this cut at that point would be that the buyers of the short-term treasuries might consider that the cut are reckless. They don't understand why they're doing the cut. It doesn't make sense. It would push the inflation up, etc. And so it just caused more concern, and more concern means that they're going to want to have a higher yield in order to buy these two-year treasury. The buyers of long-term treasuries would expect higher future inflation and also higher risk in the economy, so potentially stagflation, recession, depression, so they're not sure exactly. So that would add risk to these long-term bonds, and that would also, when we're looking at the mortgage rate, they're pretty tied up to the 10-year treasuries, so that would also mean that the mortgage rate would go up. Even though the Fed is cutting the rate, that could indicate that the short-term and the long-term treasuries could go higher in this particular situation. A lot of people are going to say, well, this doesn't make any sense, but it did happen. It's a very similar situation happened in the 1970s under Nixon, where he pressured the Fed to cut rates just before the election of 1972, and then eventually he cut the rate, and then the inflation went through the roof, the mortgage rate went through the roof, they ended up in a stagflation, and it was just horrible until Volcker can come in in the 80s or something like that, and really made some drastic moves in order to get these things under control. So what are the two moves that I think you should consider, you should investigate? And the objective for these two moves is to really asset protection and inflation protection while keeping an upside. You're still investing, you're still getting gains, but you're just really protecting your asset and then protecting also against inflation and maybe even improving your purchasing power. The number one is to reduce stock market bubble risk. I think we all agree that it is in very high territory. It's breaking records every week. So be more liquid, take your profit if you can, and then rebalance frequently to make sure that you're not overly exposed to some riskier stocks, unless you're planning to ignore it for 20 years and say, okay, well, forget about it. I'm just going to set it and forget it, and 20 years from now, we'll see where that is. But in the shorter term, I think you want to kind of make sure that you rebalance frequently, take your profit. Now, also I want you to make sure that you realize that BTC, a lot of people are going to say, well, I'm going to invest in BTC instead because it's safer, it's like gold. Well, BTC is correlated with the stock market. If I look at the stock market today, here's the stock market today. So here's the NASDAQ here. You can see the NASDAQ went down from here to there, down 0.13%. And you can see that the Bitcoin is down 0.6% on the day. And this is very typical. So the Bitcoin is correlated with the stock market. If the stock market goes down, the Bitcoin is also going down, and it's going down faster. The stock market is going up, Bitcoin is also going to go up, and it's also going to go up faster. So it's kind of like an amplifier of the movement for the stock market. The second move that I recommend is to diversify in real estate. So this is a good time actually to buy. As you see, there's more and more supplies of properties or assets in the market right now. Real estate is always good because you have appreciation, you have tax benefits, you have cash flow. And leverage is key. It's the best way to protect yourself against inflation because you're leveraging today's dollar and you're paying it into the future dollars that is going to have a lower purchasing power. So this is the advantage of that. If you need some help on how to set yourself up with a game plan, you can download my Investor Game Plan Starter Kit. The link is going to be in the description below. And this starter kit will basically help you isolate the best investment strategy to achieve your goals. And then you can also book a call with me and we can go over that if you need it. So all the links are in the description below. There's a lot of opinions out there about what's going to happen, what people want, and all of that. And everybody has some kind of different motivations about why they want the Fed to cut the rate. This is why you need to stay informed. This is why you need to download my Investor Game Plan in the description below. You want to click the like button and subscribe to this channel, and see you next time.